If you think building a portfolio that pays you $1,000 every month is impossible, you may be making the exact mistake that keeps millions of Americans financially dependent on their paycheck for decades. Right now, there are people earning dividend income while they sleep, while they travel, and while they spend time with their families. Meanwhile, most workers are trapped in a cycle where every dollar they earn requires more of their time. And the gap between those two groups gets wider every year. What makes this even more concerning is that most people never realize the mistake until it is too late to recover years of lost compounding. Today, I am going to show you exactly how a complete beginner can build a portfolio capable of generating $1,000 per month in dividend income, starting from zero. But before we get there, you need to understand a number that could completely change how you think about money. Because once you see this number, you will understand why so many people struggle financially despite earning decent incomes. Let us start with a simple question. How much money do you think you need invested to generate $1,000 every month in dividends? Take a guess. Most people get this wrong. Some think it is $50,000, others think it is $1 million. The real answer sits somewhere in between, and understanding it is the first step toward building real passive income. To generate $1,000 per month, you need $12,000 per year. Now here's where things get interesting. If your portfolio generates a 3% dividend yield, you would need roughly $400,000 invested. At a 4% yield, you would need about $300,000. At a 5% yield, you would need approximately $240,000. And before you click away because those numbers sound huge, stay with me, because this is exactly where most people make a critical mistake. They see the destination and completely ignore the path. Nobody starts with $300,000. The investors collecting meaningful dividend income today did not wake up one morning with a massive portfolio. They built it step by step, month by month, year by year. But here is what nobody is telling you. The biggest threat to your financial future is not a market crash. It is not inflation. It is not even a recession. It is waiting. Every year you delay investing is a year your future portfolio loses something it can never get back. Time. And time is the ingredient that does most of the heavy lifting. Think about two investors. One starts investing $500 per month at age 25. The other waits until age 35. The second investor may have a higher salary. They may invest larger amounts. Yet they often struggle to catch up because the first investor gave compounding an extra decade to work. That is how powerful time can be. If this is valuable, hit subscribe now so you never miss what we reveal next. Now let us talk about the strategy, because knowing the destination means nothing if you do not know how to get there. The first rule is surprisingly simple. Stop trying to find the perfect stock. The financial media loves to talk about the next big winner. But investors building dividend income focus on something completely different: consistency. Instead of chasing excitement, they buy quality assets repeatedly, month after month, year after year. This brings us to what I consider the most important concept in dividend investing: dividend reinvestment. Most beginners see dividends as spending money. Successful investors see them as growth fuel. When a dividend payment arrives, they reinvest it. That dividend buys more shares. Those shares generate more dividends. Those dividends buy even more shares. And over time, the snowball becomes larger and larger. At first, progress feels slow, painfully slow. But then something remarkable happens. The portfolio begins contributing more growth than your monthly deposits. That is the moment many investors realize they have crossed an invisible line. Their money is finally working harder than they are. To fully grasp how this math operates over a multi-decade timeline, we must analyze the exact mechanics of a three-stage dividend avalanche. In stage 1, your capital is doing all the heavy lifting. Your monthly deposits represent 99% of your portfolio growth, and your quarterly dividend payouts feel small, perhaps enough to cover a cup of coffee or a minor utility bill. This is where 70% of retail investors quit because they look at their initial data and mistake slow progress for no progress. In stage 2, which typically occurs between years 7 and 12 of a consistent allocation strategy, the math shifts dramatically. Your accumulated shares begin generating hundreds of dollars per quarter. When these funds are automatically swept back into your holdings via a dividend reinvestment plan, the system initiates a self-funded purchasing loop. The dividends themselves are now buying fractional shares without you adding a single extra dollar from your active corporate salary. By the time you enter stage 3, the system hits an escape velocity. The annual dividend growth rate of the companies you own, combined with your automated reinvestments, creates an expansion curve that outpaces your active financial contributions. At this level, your wealth generation is fully decoupled from your daily labor. Now here is where it gets interesting. You do not need dozens of stocks. You do not need to spend hours analyzing earnings reports. Many successful investors build around a handful of diversified dividend exchange traded funds and a small collection of high-quality dividend growth companies. The goal is not complexity. The goal is ownership. Ownership of businesses that continue generating profits year after year. To execute this safely, you must understand the critical difference between high-yield traps and sustainable dividend growth. A common trap for beginners is sorting an online stock screener by the highest dividend yield available, often finding companies offering 10, 12, or even 15% annual payouts. In almost every scenario, an exceptionally high yield is an explicit warning sign from the market that the underlying corporation is in deep distress. If a company is paying out more cash than it generates in free cash flow, the management team will eventually be forced to slash the dividend to preserve capital. When a dividend cut is announced, the stock price typically plummets, causing you to lose massive amounts of principal capital in a desperate search for short-term yield. Instead of chasing high-yield traps, elite wealth managers prioritize companies known as dividend aristocrats or dividend kings. These are elite corporations that have not only paid a dividend, but have successfully increased their dividend payout for 25 and 50 consecutive years, respectively. These businesses possess durable competitive advantages, robust balance sheets, and pricing power that allows them to pass the costs of inflation directly down to the consumer. When you own these enterprises, your baseline income streams are structurally protected against macroeconomic shifts. Let us transition directly into the exact portfolio construction models that are driving long-term passive wealth right now. A highly effective, low-maintenance framework involves a two-bucket allocation model. Bucket 1 is your structural anchor, consisting entirely of broad market, dividend-focused exchange-traded funds. These funds instantly diversify your capital across hundreds of individual blue-chip corporations, eliminating individual company risk while ensuring you capture the overall upward trajectory of the commercial economy. A core asset in this bucket might track an index of companies selected specifically for their consistent track record of dividend increases and low volatility. By dedicating 60 to 70% of your capital to this anchor bucket, you establish a highly resilient, stress-free foundation that requires zero daily monitoring. Bucket 2 is your acceleration engine, where you allocate the remaining 30 to 40% of your capital into select individual dividend growth equities. In this bucket, you are looking for specific corporate metrics that signal an ideal balance of current return and future payout expansion. The first metric to verify is the payout ratio, which measures the percentage of a company's total net earnings used to pay its shareholders. For maximum safety, You want to target a payout ratio below 60%, leaving the corporation with plenty of retained earnings to reinvest in research, pay down corporate debt, and sustain the dividend during a temporary economic downturn. The second metric is the 5-year dividend growth rate, which tells you how fast management is raising the payout. If a company has a current yield of 3% but is growing that dividend at 10% per year, your yield on your original cost basis will compound into double digits over time. Stay with me, because this next part is critical. Most people focus entirely on the accumulation phase, but they completely ignore the structural drag of taxation. If you build your dividend engine incorrectly, a massive portion of your passive income can be siphoned away every year by federal and state governments before you ever touch a single dollar. To optimize your net returns, you must understand how different investment accounts alter your financial trajectory. If you hold your dividend assets inside a standard taxable brokerage account, you will be subject to dividend taxes in the exact year those payments are distributed, regardless of whether you choose to reinvest them or cash them out. While qualified dividends are taxed at lower preferential capital gains rates rather than standard ordinary income brackets, this annual tax drag still reduces the ultimate compounding speed of your wealth engine. To bypass this bottleneck during your accumulation years, strategic investors maximize tax-advantaged vehicles like traditional and Roth individual retirement accounts. Inside a tax-sheltered account, your dividends are allowed to spin off and auto-reinvest with zero tax consequences, meaning 100% of your generated cash flow remains inside the portfolio to fuel the compounding snowball. If you utilize a Roth framework, every single dollar of that eventual $1,000 monthly distribution stream can be withdrawn completely tax-free once you cross the retirement age threshold, giving you an unassailable financial fortress that is fully insulated from future tax policy increases. Every dividend payment is a small step toward that goal. Every reinvested dollar is another employee working for you. Every month you stay invested increases the probability of future income. So if you are starting from zero, here is your structural action plan. Open your chosen account framework. Set up an automatic monthly investment. Choose diversified dividend-focused investments. Turn on automatic dividend reinvestment. Increase your capital contributions whenever your active income increases. And most importantly, keep going when the results feel small. Because the investors who eventually collect meaningful dividend income are rarely the smartest. They are usually the most consistent. And years from now, you will either be glad you started today or you will wish you had. The choice begins with your very next investment.